As a quick disclaimer, before this video starts, this content is for educational and entertainment purposes only. You should keep in mind that all investing involves risk, and that includes the possible loss of principal. Hey guys, how has this week been for you? My new job really keeps me busy in a way that I don't feel stressed in, and I think that is rare. I've grown to like it quite a bit actually. Today we'll address a topic that many of you have asked me about. And even though I touched on it a bit before in other videos, I thought it deserved a longer, more detailed video on its own: investing. Before starting out, I'll present the sections I'll talk about in this video, and if you are only interested in a certain topic, you can skip directly to it. Firstly, we'll understand what is inflation and why it is useful to invest our money. Then we'll have a rundown on what you can invest in based on your personal risk tolerance. And finally, I will let you know how you can actually start investing and the good method, principle, and mindset I personally have when I do it. Let's say you start earning some money either by working a job, freelancing, or maybe as a gift from your relatives. Now you want to put some of them aside for rainy days. I firstly started with 3 to 6 months of my monthly living expenses to have a buffer, just in case I lose my job or a bigger unexpected expense comes along. Maybe my car breaks down or something. After you have this covered, you could keep setting more money aside as cash in your bank account. But there is a thing called inflation. Inflation makes the prices of all the things around you rise by 1% yearly, and this phenomenon will make your sitting cash money lose its value over time in contrast. That's why it is not that great of an idea to have more money than an emergency fund sitting around not being invested. Now that we've understood why we need to invest our money and how we are guaranteed to lose some of it in the long run even though we are seeing the same balance in our account, the investments you may choose to do with them vary greatly on your risk tolerance. From safest to least safe, we have bonds, real estate, stocks, ETFs, and crypto. Let's quickly run through them and understand what they are. Maybe some of them are a good fit for you. Bonds are often considered one of the safest investment options, especially government bonds. When you invest in bonds, you're essentially lending money to a government or corporation in exchange for periodic interest payments and the return of the bond's face value when it matures. They are generally seen as safer than stocks because they are likely to receive steady interest payments and eventually get your initial investment back. However, this safety comes with lower potential returns. Bonds tend to have lower yield compared to stocks, meaning your money won't grow as quickly. But if you're more risk averse and looking for stability, bonds can be a good addition to your portfolio. This rule is always true in investing and in life. The higher the risk you take, the higher the returns will be. If the S&P 500 index, which contains the 500 biggest companies in the United States, will grow yearly by about 11%, bonds will only return 4 to 5%. Both of these options would be better though than inflation eating away 2% of your money yearly, or even more these days. When it comes to stocks, the right companies tend to increase in market value and thus in stock share price because they provide value yearly. They have employees working and factories that are expanding. But investing in individual stocks can be risky if you're not sure what you're doing or if the companies you invest in perform poorly. There is a better, less risky alternative to this that I prefer that we will talk about in a bit, called ETFs. Real estate is another popular investment class. When you invest in real estate, you're buying physical properties, houses, apartments, or commercial buildings that you can rent out or sell later for a profit. Real estate is often seen as a stable investment because property values generally increase over time, and you can generate passive income through rent. However, real estate requires a larger upfront investment and comes with maintenance costs, property taxes, and sometimes mortgage payments. It's also not as liquid as other investments, meaning you can't easily sell property like you can stocks or bonds. That said, real estate can provide both income and long-term appreciation, making it an attractive option for many investors that have large capital. Now my favorite of them all, ETFs. They are a great middle ground for many investors. An ETF is essentially a basket of stocks or other assets that you can buy and sell on a stock exchange just like a regular stock. The beauty of ETFs is that they offer diversification without needing to pick individual stocks. For example, instead of buying shares in a single company, you can buy an ETF that tracks the S&P 500, giving you exposure to the top 500 companies in the US proportionally by market valuation. ETFs are generally less risky than buying individual stocks because they spread your investment across many companies, sectors, or even asset classes. They are also more accessible as you can start with smaller amounts of money. ETFs like SPY, which tracks the S&P 500, are considered relatively safe long-term investments, averaging about 10 to 11% return annually. They are perfect for someone looking to grow their money steadily over time without taking on too much risk. There are a lot of good options to choose from here. I personally invest in SPY and SPLG, which both track the US markets, but you can further diversify into other markets by choosing an ETF that tracks other countries, areas of the component companies, or even the whole global market. Lastly, cryptocurrency or crypto is the most speculative and volatile asset class on this list. When you invest in cryptocurrencies like Bitcoin or Ethereum, you are buying digital assets that aren't backed by any government or traditional financial institution. The appeal of crypto lies in its potential for high returns in a short period, but this comes with a lot of risks. Cryptocurrencies can see massive price swings both up and down in a matter of days. While some people have made significant profits, others have lost large sums when the market crashed and they sold. If you're interested in crypto, I recommend only investing money you're prepared to lose, as its future is uncertain and the market is highly volatile. I myself wouldn't have more than 2 to 5% of my portfolio in this. Now, how do you actually buy these stocks or ETFs, you might ask? Well, it's actually pretty straightforward once you know what to look for. The first step is to open an account with a brokerage firm. A broker acts as the middleman between you and the stock market, allowing you to buy and sell shares, ETFs, bonds, and other assets. There are plenty of online brokerage platforms available today, each with different features, fees, and minimum deposit requirements. If you're just starting out, look for a broker that has low or no trading fees, a user-friendly interface, and educational resources to help you understand the process. You can look up the best brokers available in your country. A quick Google search will help you find the most trusted and regulated platforms near you. Once you've picked a broker and opened an account, you'll need to deposit money. Many brokers allow you to link your bank account directly for easy transfers. From there, you can start exploring the platform, searching for specific stocks, ETFs, or bonds that you are interested in. For example, if you're looking to invest in the S&P 500 through an ETF, you could search for the SPY ticker symbol, that is SPY, on your broker's platform. Similarly, if you're interested in tech stocks, you might look up companies like Apple with the symbol of AAPL or Microsoft with the symbol of MSFT. Keep in mind that some brokers also allow fractional shares, meaning you can invest in a portion of a stock rather than having to buy a whole share. This can be a great option if you are starting with a smaller budget but still want exposure to high-priced stocks. And before you make your first purchase, do your own research on the assets you want to invest in. Understand the risks involved and make sure they align with your long-term financial goals. One of the best strategies for long-term investing success is dollar cost averaging. This simply means that instead of investing a lump sum of money all at once, you invest a fixed amount at regular intervals, whether it's monthly, quarterly, or even weekly. By doing this, you buy more shares when prices are low and fewer shares when the prices are high. Over time, this can help reduce the impact of market volatility, which means how much the prices actually change, and lower your average cost per share. For example, let's say you commit to investing $100 every month into an ETF. In months, when the ETF price is lower, your $100 will buy more shares, and in months, when the price is higher, it will buy fewer. This gradual investment approach smooths out the ups and downs of the market and eliminates the need to time the market, which even expert investors struggle to do consistently. In the long run, the combination of regular contributions and the compounding growth of your investments can make a huge difference. The key is to stay consistent even during market dips or crashes and keep your eyes on your long-term goals. So instead of worrying about trying to pick the perfect moment to invest or getting discouraged when the market drops, embrace dollar cost averaging. Stick to your plan, and over time you'll be in a much stronger financial position. To wrap things up, investing can be a powerful tool for building long-term wealth, but it's important to understand the basics and approach it with patience and consistency. Start small, diversify across different asset classes, and consider using strategies like dollar cost averaging to manage risk and take advantage of market fluctuations. Remember, investing is a long-term game, and the sooner you start, the more time you give your money to grow exponentially. If you have any thoughts, questions, or experiences you'd like to share, drop them in the comments below. I'd love to hear how you approach investing or if you are just starting out. Don't forget to like, subscribe, and hit the notification bell for more content like this. Thank you for watching, and until next time, happy investing!